The broadcast is now starting. All attendees are in listen-only mode.
All right, good afternoon, everybody. My name is Bobby Rains. I'm here for our once every 3 weeks members-only workshop. As always, this is mostly about you. So, by all means, feel free to put questions in the question box. We will get to as many of those as we can, either as we go along, if it's relevant in the moment, or at the end, if that makes more sense. All right, so let's get going. We have our pretty standard agenda this time through. What's going on in Investors Observer, market update, member-driven content, and as always, we got some questions ahead of time. That gives me a little more time to put my thoughts together. But I'm happy to answer things at the moment. But yeah, you can just reply to that invitation with your question, and that comes right to me, and that is where I get most of the questions that we prepare ahead of time. All right, so we don't have a lot of big Investors Observer news this week. We have some stuff we're working on, but nothing we're ready to announce just yet. Keep an eye out for announcements. We got a lot of good stuff on our news page, both from our partner MT Newswire and the stuff that our analysts are writing and publishing every day. So, also keep an eye on that stuff. All right, so let's get into what's happening. All right, this is our regular S&P 500 chart. There's really not that much to say about it. We have hit the new high since the last time we spoke, but yeah, at all-time highs, there really isn't much to look at on the chart. You would sort of expect the old high to be resistance on the way back down. So we do have that's different. But other than that, there's really not a whole lot to be learned from this chart as far as I can tell. Now, this chart is actually from the last workshop. This is the S&P 500 in white and the equal weight S&P 500 in blue. The difference there is the S&P 500, the white line, is market cap weighted, and the blue line is every stock is treated equally. So in the white line, Apple is some giant percentage of that line, and the blue line, Apple is the same percentage as, I don't know, whatever the 500th largest company is. They're all the same. So this was from 8.3. You can see S&P 500 had just broken out to be positive over the last 6 months, where the equal weight was still down about 6%. Since then, I kept the same starting date here. Equal weight is at down 4%, and the 500 is still up. It's up more than 4%, getting close to probably 5 or 6% at this point now. And that spread is something that's interesting to keep track of, just because as those big companies get bigger, they account for more and more of the market. If you haven't heard the term K-shaped recovery yet, get ready. I started hearing it originally months ago. We're starting to hear it more and more, and that's kind of what is happening here. Is if you think about a V-shaped recovery where something goes down and then comes up, or an L-shaped recovery where something goes down and then doesn't come back up, a K-shaped recovery is exactly what it sounds like, in that some things bounce back really fast and some things sort of don't bounce back. And that's kind of what we've been seeing now. Is those 5. It's they've added enough letters now that it's pretty unpronounceable, but Facebook, Amazon, Apple, Netflix, Microsoft, Google. That's kind of the market leadership right now. That's almost all of the difference in this chart here is that. So that's kind of what's going on here. All right, so what else is happening? Uncertainty is still sort of everywhere. Things are still moving faster than traditional economic data can really keep up with. Um, it's kind of pivoted in an interesting direction recently, which we'll talk about in a couple of bullet points. But yeah, all that data in any case is backward looking, whereas the market is forward looking. Um, so sort of keep in mind that if, as data comes in, the data is telling us about what's already happened. And so that's why sometimes the market and the data may not seem to make sense, because the market is essentially trying to put a price on the future, whereas the data is telling us what's happened in the past. So the data can certainly inform the future, but it's not a one-to-one necessarily. Yeah, people are still looking at the alternative data, which we'll look at a little bit in a few minutes. And yeah, the whole reopening and reclosing thing is a process. Schools remain a big deal, both at the K through 12 level, where people are trying to figure out, exactly what's going to happen with their kids' schools, how that affects their work schedule, how many people can do a video conference at once on their home Wi-Fi, all those kinds of things. It's possible that economic level activity will see sort of a new level as we move into sort of a new phase here with the school thing happening. I don't know exactly what that looks like. The other thing, living in a college town, I would expect that certainly we'll see what the student economic activity looks like. But outside of that, yeah, we're in Charlottesville, which is where the University of Virginia is, and the ACC for now is still having football. But some other sports may not be happening, and football doesn't seem like it's going to have a lot of fans. So that's a lot of economic activity that probably isn't going to happen. So things like that, we're still sort of keeping an eye on, and not sure exactly how to model. I mean, will people spend that money somewhere else, or will they just not spend it? Is kind of where that goes. And yeah, more recently, as I said, the economic data has actually been better than expected, but that's partially a function of expectations being incredibly low. Durable goods orders beat this morning. Durable goods are things that are expected to last longer than, I think it's 3 years. So that's, washing machines, cars, things like that, right? Not your consumables. And so that was interesting. Like I said, lots of that was transportation. My guess is some amount of that was probably pent-up demand. I don't think anybody was going to car dealerships earlier in the year. But now that things seem to have loosened up a little bit, people know where the virus hotspots are, things like that. I guess some of that was transportation. I think there's a decent chance that a fair amount of that was RV sales. RV sales have been doing pretty well recently, both the sort of direct-to-consumer market, and then also, it's hard to get good data on it, but anecdotally, at least, lots of people have, instead of having a more traditional vacation, have tried to do something where they rented an RV to go somewhere or something like that, because you can be much more self-contained as a family unit in that way, as opposed to having to have a lot of interactions through hotels or whatever. So it'll be interesting to sort of see how that shakes out. And then, yeah, the economy has been very strong. Or sorry, not the economy, housing has been very strong. That again sort of speaks to that K-shaped recovery, in the sense of, the people who are impacted less by the pandemic and reactions to the pandemic are people who can work from home. Those are typically people at upper incomes who have jobs that deal with computers, things like that. Those are also traditionally your home buyers, right? A lot of, like restaurant staff and other service industry workers, those people are less likely to own their own home anyway. So that, the housing thing has been sort of strong. It's interesting, inventory has kind of been a constraint. There was some delay in, construction. I think some number of people have probably been hesitant to put their house on the market during this. So that's been a little bit of a constraint on sales, which does help to support prices. So yeah, that's where that is, and that'll be interesting to sort of keep watching. The price of lumber has gone way up recently because a lot of lumber gets imported from Canada, and there's been some issues there. And then, yeah, lots of people have been trying to build houses or things like that. So there's been a spike there, which may serve as something of a constraint on the supply of housing at some point down the road. It may also just help keep the price of new homes high. And yeah, going forward, employment is going to be a key thing to watch. In addition to the layoffs we know about, American Air said they were going to cut 19,000 jobs earlier this week. And they're cutting as the sort of government support runs out. Delta is going to furlough 1,941 pilots. Again, as the government support runs out. Salesforce announced today they're cutting 1,000 jobs, and there's a ton more that either aren't mentioned here or have to be announced. So that's kind of a good transition to what are we watching, right? What to keep an eye on. So the Fed is having a very low-key, I think mostly Zoom version of their annual conference in Jackson Hole, Wyoming. The keynote is expected to be Jay Powell's speech tomorrow, where he's expected to announce something called average inflation targeting. And what this means really is just that the Fed has for a long time said that they sort of had tried to keep inflation at around 2%. And what they did in the last recovery was they started to raise interest rates, which should slow down the economy and slow down inflation to some degree. They started to do that way before inflation got anywhere close to 2%. And so what average inflation targeting means is if inflation runs below 2% for a long period of time, they're willing to let inflation run above 2% for some period of time to try to support what is essentially the Fed's dual mandate of both price stability and maximum employment. So I think the traditional thinking had been that, if we got, first it was 5, and then it was 4, and then it was like 3.5. Some very low level of unemployment should lead to higher inflation, but we didn't really see that in the last recovery. And I don't know exactly what to expect from that longer term. I would expect sort of some volatility tomorrow as the market chews through the particulars there. But honestly, at this point, I think everybody knows what to expect. So it's really hard to say how that should affect stock prices in particular. But yeah, there may be some. Powell has gotten better about not surprising the market, so it's entirely possible there'll be no real effect. But I don't think this is gonna have much long-term effect on the market either way, outside of what we already know, which is that interest rates are expected to be very low for a pretty long time. Yeah, employment data is still, I really think the big key here. There's still lots of people filing first-time claims each week. The number has slowed down a little bit. Some of the continuing claims stuff has started to get better. But we're still at levels where, we'll see what tomorrow is, but last week's number would have been the all-time record for first-time unemployment claims, if not for everything else we've seen this year. So that's certainly something to keep an eye on, and it's really hard to know exactly what that means for the economy because it's hard to tell exactly what the employment situation is. And the reason that's so important for the overall economy is I forget the percentage, a massive percentage of the economy is driven by consumer spending. And so if a large number of consumers either don't have money because they're not working or feel like they'd be better off saving because they're worried about losing their jobs, the recovery suffers. And then, yeah, Congress is this sort of missing piece here. A new aid package. I mean, the airlines have, straight up just said, like, we're cutting these jobs when we run out of the money the government gave us. Presumably that at least implies that they would not cut those jobs if they don't run out of money the government is giving them. whether that's a good idea is a sort of different question. But for the market in particular and the economy as a whole, a new aid package would definitely provide some support there. Yeah, and if I had to guess, I would guess that some sort of package will get passed eventually, but I think it may take some really bad economic data and possibly a little bit of a stock market freak out to get people's attention. That's kind of how this sort of brinksmanship has worked in the past, but we'll see. All right, so let's look at some of what we're calling fast data, right? This is the sort of things that people are looking at now because the traditional economic data is on such a lag. This is also on a lag, right? This is Chase's consumer spending tracker. So this is from August 22nd. Consumer card spending is now down 8.8% from a year ago compared to 9.3. I think that's the day before. And yeah, it's up a little bit week over week, and it's up, quite a bit from the March 30 low. But it's still down about 10%, and that's about as high as it's been since all of this started. It kind of, started to rise and then rolled over a little bit. So we'll see how that goes. This tracks honestly pretty well. Sorry, I just dropped my mouse. The nice thing about a wireless mouse is it doesn't have wires. The bad thing about it is if you knock it off the table, it falls all the way to the floor. Yeah, it got to here before, and then, infection started to rise, things started to get locked down again, and it went back down, and it slowly sort of climbed back. So it'll be interesting to keep an eye on this one in particular. The other one we've been watching is the TSA. It's definitely gotten a lot better since the last time we talked. I think we had almost hit a 700,000 passenger day on whatever the last 3 weeks ago. August the 5th was our last workshop. It does sort of seem like it's still a little bit flatter than it was, in this period, but there is a definite uptrend from here to here, and it's hard to tell if this is right. I think we're catching this at a weird point in terms of where the weekends fall. But yeah, it still ends up being kind of noisy. And then if we look at the rate, it has stopped rising, and so this is the growth rate. So it's the rate of change in this. So anything below the middle line here is a decline in the growth rate. So yeah, it's not exactly what we would like, but the data does look a little bit better there than it did the last time. It's by no means a V-shaped or any sort of rapid recovery, but it does seem like things are slowly getting, I wouldn't even say back to normal. Things are slowly improving in that regard in terms of the number of people traveling. All right, so yeah, that is it for the sort of market update, and now we are on to the questions. So, not very many people gave their names this time, so I just took their email address and cut off the @ sign in terms of these names. I don't know if these are actual people's names or just their online handles. So Maywin said, what should you do if you made a bad trade and the price of the stocks keeps decreasing? Should you get out while you can and wait for the price to bounce back? And at what percentage of loss should you get out? I mean, this is a very common series of sort of beginning investor questions, and there really isn't an answer. It's a very situation dependent sort of set of questions, right? So did the stock go down for a reason, or did the whole market just tank is one thing, right? Like if the whole market is up and your stock is down, that's certainly something to treat differently than, oh, hey, the whole market is having a bad day and yeah, my stock is also down. That's one thing to consider. And then the other was, what was your reasoning for buying the stock? Does it still stand? Right? So like if it's a stock that you bought because you think the company is great and it's going to grow over the next 10 years, then what it does in the first week you own it really doesn't matter that much. If it's a stock you bought because you were expecting them to announce some sort of miracle drug and it turns out the drug doesn't work, right? That's a very different situation. So your reason for buying the stock and sort of did all the things you evaluated to make the decision to purchase, how many of those still hold up? That's another thing to consider. And then another one that is sort of a summary of the first is, would you buy the stock today, right? So if you liked it at 55, do you like it more at 50 or do you like it less? And that's, again, has to do a lot with less than the absolute price and with what the news has been, right? If you liked it at 55 because of X, Y, and Z, but now it's at 50 and X, Y, and Z aren't really true anymore, that may be a time that you want to get out. Option trades, the considerations are pretty similar, but it's a little bit different because there is a defined time element, right? Options expire, right? If you buy a stock because you like the company and you think it's a great company, you can hold that until you decide the company isn't a great company anymore, right? There's not necessarily a time limit on that. Options, right? Like there's an expiration date right there in the option symbol. You can hold it until then, but you can't hold it past that. And so things like your simple calls and puts and your vertical spreads have this problem a lot because those tend to be sort of shorter term, and you have to get out at a relatively short basis. And in those cases, especially in the vertical spreads, typically what we say is start looking for the exit as soon as it seems like the trade is more likely to lose than to win. And that can be a couple of days in, it can be a couple of days from expiration. It doesn't necessarily mean something bad happened, I have to get out now. You can try to wait for a bounce or something like that. That's waiting for a bounce is a sort of thing that I think people would say they've had mixed success with, sort of at best. And that does depend on the time, right? If you have a trade that lasts for 3 days and the stock starts to fall, you don't have a lot of time to wait for a bounce. Whereas if you have a trade that goes for 2 weeks or a month, you can kind of wait for a bounce on that level. Things don't usually go down every day for a month. Now, it's possible the stock can go down far enough that when the bounce finally comes, it's of no help to you at all. That's a different question. But those sorts of time things do play in there. And yeah, other strategies can be more flexible, right? Your covered calls and diagonal spreads, we can hold those things for a lot longer, sell new calls against them, and definitely work on the, sort of repairing things. All right, so I see we already have questions coming in about this in the question box. So yeah, let's do it. Jerry asked, how likely is it the prices of Apple and Tesla might pull back a little bit after their stock splits go into effect? And might it be worthwhile buying short-term puts on these stocks in anticipation of this? Alternatively, maybe set up a bearish vertical call spread. So first, I want to talk a little bit about stock splits. I don't know exactly everybody's level of understanding of stock splits. I've seen a ton of stuff on the internet about how it was going to cause the stocks to go up, it was going to cause the stocks to go down. So let's talk about what a stock split is. A stock split doesn't actually have any real effect on the value of the company. Okay, you're basically trading a $5 bill for 5 $1 bills. There are some things that may happen around the margin, but there's no real change in the value of the business. Okay, so what's happening here is, right, let's pretend we have a company that's worth $100 and there are 10 shares outstanding. So each share is worth $10. We can split those shares 5 for 1, and now our share price is $2 and we have 50 shares, but the company is still worth $100. Okay, there's no difference. And by the way, each shareholder who had $10 worth of stock before still has $10 worth of stock. The difference is instead of one $10 share, they have 5 $2 shares. So those things around the margins are kind of interesting, right? So lower stock prices may open the door for some new investors, but how many new investors trading in I mean, what we're talking about here is people who can't afford to buy Apple now, but might be able to afford to buy something less than 4 shares post-split, or in the case of Tesla, less than 5 shares post-split. It takes an awful lot of people buying 1 or 2 shares to move the price of a company like that. And so then in terms of trading behavior, what you have is there's sort of a little bit of a push and a little bit of a pull in either direction. So again, lower stock prices may open the door for some new investors to come in. Again, I have a hard time seeing how that really affects the price, but it's possible some people could do that. On the other side, people who have either one of those stocks are sitting on gains. And so now, instead of selling, $500 worth of Apple or $1,500 worth of Tesla, you can sell somewhere, $300 worth of Tesla, $100 worth of Apple. You can sell out smaller units. So it's possible some people could sell there. I have a really hard time imagining that there's much impact that goes beyond next week. I think people trying to speculate on what the split means has a lot more impact on the price than the actual split does. And so yeah, the effective date for both of these splits is the 31st, which is Monday. So they will split before the market opens. So if you have 1 share of Apple at the close on Friday, you'll have 4 shares of Apple at the open on Monday. The options contracts are also going to split. So if you have, 1 contract becomes 4 contracts of Apple, 5 contracts of Tesla, and the strikes are going to be either quartered or divided in half. So that means a Apple option with a $400 strike price becomes 4 options with a $100 strike price. Your position is essentially exactly the same, right? It's the same size in terms of dollars. The strike price is the same. The relation to the stock price is the same. There's really no difference. It ends up being potentially sort of an accounting headache, but that's about it. And so we have some questions in here like, should I wait for the stock split for Apple or can I buy it today? It really doesn't matter, right? Like if you want to buy $100 worth of Apple, you're going to have to wait till Monday unless you're trading it like Robinhood or one of these other brokers that offers fractional shares. But unless you're literally constrained by not being able to afford the price of 1 share, it does not matter if you buy it today or buy it Monday or what have you. I don't think it's going to have a big impact on the price. I don't think it really means much for either stock long term. Apple split probably means more for the Dow than it does anything else because the Dow is price weighted and weird. Anyway, so that's what I have to say about the Tesla and Apple stock split. Oh, I skipped one. Okay, so can you explain the downside protection in your covered calls and short put suggested trades? The downside protection is very simply the difference between the current price of the stock and the break-even price for the trade. So essentially it is how far the stock can move to the downside and you're still sitting on a profit. In a covered call, the break-even is the same as the net debit. So you buy the stock for a price, you sell a call for a price, the amount you paid out for the stock minus the amount you brought back in for the call, that's your net debit, that's your break-even. In a short put, the break-even is a little bit harder. It is the strike price minus the credit you get for selling it. In either case, it is basically the cost of ownership of the stock if your option is, well, in the covered call, it's if the option expires worthless. In the short put, it's if the option is assigned. And yeah, subtract the break even from the current price and you get the downside protection. And we tend to give that number in dollars or in percents just so you can sort of compare it across stocks. $1 worth of downside protection on a $100 stock is different than $1 in downside protection on a $10 stock. All right, now we're at the end of the previously submitted questions. And so anything anyone has asked in the box so far. We'll go through. All right, Jack says, I get how you calculate the technical scores. Can you summarize how you calculate the fundamental score? Yeah, Jack. So what we do there is we look at the PEG ratio, which is the price to earnings ratio divided by a growth rate, where 1 is typically considered to be about fair value. And so that's one of the pieces. The further away you get from 1, the further away you are from fair value. And then we also look at some things like what analysts are saying about it, what the analyst price target is, things like that. Those guys are in the company on a level that we just can't replicate. We could do a handful of stocks at that level if we wanted to, but we're trying to be full service, and we think it's probably actually more valuable to give you the average of a bunch of analysts than just have one analyst that we stick on it. And those are the basic components there. So Michael says, the longer the SPY rallies, does that mean the market correction, whenever it comes, will be more quick and violent? Don't really think so. I don't think there's a lot of necessarily evidence for that. Corrections tend to be not caused by the length of the rally, right? Like, the saying is, bulls don't die of old age. Usually something happens, and that is what gets a correction. And it's either, something that's big and does long-term lasting damage to the economy, or it's something that we get over relatively quickly. And in some weird cases like we've seen this year, it's a big thing that seems like it's going to do lasting damage to the economy, but spares enough sort of small segments of the economy that there are some companies with incredible scale that aren't really hurt by it very much. And those stocks keep going up and pull up the average. So we have a question here that says, in these times of volatility, which should we prioritize, technical or fundamental analysis? Really, this comes down to a question of holding period, right? Like, if you're trying to day trade, doing the Ben Graham, Warren Buffett's, this stock is undervalued thing isn't going to work, right? You can probably do just as well throwing darts at that level. Whereas if you're trying to, actually, hold stocks for as long as Warren Buffett does, which is, years or decades, trying to figure out what's going on from the last, 10 or 15 candlesticks is probably not all that informative either. And generally, I think that's sort of the spectrum that I would view those things on. Is technical is probably much more important for people who are short term, and fundamental analysis is much more important for people who are long term. Companies that are losing money, those stocks can go up for a while, but at some point you either have to start making money or your stock stops going up. That has been the history of the stock market so far. There is no company that I can think of that has consistently lost money for more than several years. It goes on for longer than you might think sometimes. You can keep selling shares or things like that. But yeah, you can't lose money forever and stay in business. Whereas you can lose money and have your stock go up for a while in the short term. All right, so Michael says, where do we see the S&P 500 at the end of Q4? I don't know. That's putting a price target on the S&P 500 isn't really what we do here. But generally, I think if you asked 100 people on Wall Street on January 1st what their price target was, they would have probably given you a number. And then if you had asked them on, I don't know, say March the 1st, they'd probably give you a very different number. And so, yeah, asking that question now feels, I don't know, sort of arbitrary. It could go sort of either way, and I don't have a good handle on it. All things considered, I expect that the stocks that have been going up to sort of keep going up, right? Barring some sort of major shift in things, and then we'll see if the economy can recover and help pull up the other guys. But yeah, right. I mean, based on the status quo, it's really hard to guess. All right. So Michael says, can you explain how your covered call service works? I'm not 100% sure I know which covered call service you're asking about, Michael. But we can talk about the things that are in the covered call subscription, and hopefully that will hit at least one of them. All right. So covered calls subscription includes everything that's in the premium subscription. So you get all of our stock analysis stuff. And then you get well, here's the options dashboard already. You get the covered calls portfolio, which is a service where our analysts pick trades. It varies, during what I would call normal market conditions, which we haven't seen since about January. We try to put about 4 to 6 new positions on. Haven't been doing that recently, but that's sort of the goal. And then we will send you a notification, an email when to open the trade. We sent out one yesterday to open a trade for this morning. So we'll send it out after the close so you can look over it, try to put the trade on, at the open the next day. And then any adjustment along the way until the position is fully closed, we'll send you updates on. And then the other thing you have access to is our option screener for covered calls and short puts. These other strategies are included in the elite service, but the covered calls package just gets covered calls and short puts. And then finally, in the morning update each day, you will get what we call our daily action trade, which is a covered call trade. And then also, I think I forgot a piece, options dashboard. Yeah, you'll get the featured trades and also the covered call and put versions of our aggressive, conservative, and balanced trades of the day. And outside of the portfolios, all of those are entry only. We don't, analysts don't follow up on all of those. It's thousands of trades a day. We certainly, don't have the ability to staff and follow all of those, but we do follow the portfolio trades. So if you're thinking of dipping a toe into covered calls, you're not really sure how it works, the portfolio is a great thing to do. If you've been doing it for a while, we got some stuff that's self-service that can save you at the very least just a lot of time spent doing subtraction. Yeah, so that's the covered call service. Joe, we're sort of in talks. It's not in progress yet, but we're in talks to redesign sort of the way the entire watch list system works. So, we do want to make it much more sort of robust in terms of telling you the things about the stocks on your watch list as opposed to basically being a list of links as it is now. All right, so Lynn asked, are we planning to add the Spider ETF in the future? We cover it from the standpoint of having scores about it. Analysts aren't following the ETF. They don't have price targets or earnings targets or anything like that. So, things that would need that data aren't there. But in terms of technical analysis and well, sentiment's also technical analysis, but yeah, in terms of those things, we cover it to the best of our ability. We have option trades on it. It's fully a part of the service in so much as there is data available. All right, any other questions? All right, so while I'm waiting to see if any more questions come in, this session, like all our workshops, is being recorded. We will send out a link to the video and a copy of the slides we used today sometime tomorrow. Excuse me. There will also be a link to sign up for the next workshop, which will be 3 weeks from today, which by my reckon is about September the 16th. So keep an eye out for an invitation ahead of that also. All right, so Jack says he's looking at now, and he wants to know about our fundamental rating on this stock. All right, so this is kind of an interesting case. Yeah, so we have a trailing peg ratio here. Let me read the question so we're all on the same page. I'm looking at a stock with a great EPS last year and this one, but the peg is 1.33 and fund rating is very low. And he means fundamental rating there. So we have a trailing peg ratio. Well, no, I think this is forward peg. We talked about this earlier this week. Anyway, the peg ratio we have is 15, which is incredibly high. And that's supported by the PE ratio of 121, whereas it's crept over time. When I got into this business, 15 was sort of considered the fair value PE ratio. I don't think the average PE for the S&P 500 has been 15 for years. But yeah, 121 in any case is pretty extended. And then the other thing to look at here is analysts do have a strong buy on it, but the stock has run up enough recently that it has passed the price target, which probably means that either analysts will start cutting these strong buys back or they'll have to raise their price target. Either one of those would push the fundamental score higher. But yeah, I mean, the big thing that jumped out to me here is the peg ratio of 15.36. That's really what's dragging the fundamental score there down. Yeah, Arun, in the same way we don't have price targets for S&P 500 at the end of the year, I don't have a price target for Apple for Friday. That's just kind of not what we do here. Guild. All right, Guild's kind of an interesting situation here. It hasn't done as well since late July there. I don't have, I'd have to dig into the news to figure out exactly why that is. Looking at the scores here, 49 is the middle, right? Like this is a percentile rank. So 49 is basically 50. It's in the middle. Gets a good fundamental score. It's actually done relatively well recently somehow. I mean, that short-term technical score is higher than I would guess looking at the chart. But again, all these things are being compared to everything else. So, there's other things that go into that. Analysts have a buy on it, but this is an interesting thing that we talk about a lot. The average recommendation here is a buy, but the analyst ranking is 24. That gives you some idea of what the skew of that data set looks like. So if we have the average analyst rating for thousands of stocks, and a buy puts Gilead better than 24% of stocks, that's right. Like that says there's a whole lot of buys and strong buys and not a lot of holds and sells, which is an interesting discussion of, sort of analyst sentiment. But also it's why we think the percentile rank value is probably more interesting than just the buy, sell, hold rating, because you don't get any sense of the skewness just from looking at the buy, sell, hold. You're like, oh, sell is good. Well, things can be a sell and still be in the bottom half in terms of where analysts, actually feel about it. So that's what that is. But yeah, I mean, again, we're not day trading here. Gilead's been around forever. It's a volatile stock. You look at that year-to-date chart, or even a 5-year, it's a volatile stock. But yeah, you go back, it's made people a lot of money. I couldn't tell you where the next 10% is, whether the next 10% is up or down. I have no idea, but overall, it looks sort of in the middle, right? Like if you wanted to buy it for a long time, maybe that's a better bet at this point, right? The PEG ratio is a little high, but in the, healthcare biotech kind of field, those PEs are usually a little bit higher. We can see here the valuation. So it's basically in the middle in terms of drug makers, but it's pretty high in terms of valuation in healthcare. So yeah, that's kind of what we think about Gilead there is all those things. All right, so we have a question here about subscriptions. It says, do we get a better quality report if we get a higher subscription? So you don't really get a better high quality report if you have the premium subscription, which is the base level subscription. You get all of our analysis of stocks. So everything on this page we're looking at here for Gilead, you get that right. If you get the premium subscription, that's what you get. If you get the elite subscription, that's what you get. What's different is with the elite subscription, you get more option strategies. So at the covered calls level, you get covered calls and short puts like we talked about a few minutes ago. When you go to the elite level, you get bullish diagonals, bearish diagonals, bullish verticals, bearish verticals, iron condors if we can make that happen. And those show up not just here, but also in our option screener. And we also have, in addition to the covered calls portfolio, we have portfolios that do vertical spreads and diagonal spreads as well. So yeah, that's that. All right, so let's see. Fernando says, if my portfolio overall score is 75, is that a good score? Fernando, what that means is that the average dollar in your portfolio is invested in stocks that have a better overall score than 75% of stocks. That seems pretty good to me. Obviously you'd want to dig into some of the other numbers depending on your goals and time horizons there, but all things considered, I'd say if the average, dollar in your portfolio has an overall score of 75, I think that's probably doing pretty well. All right, I don't really see any more questions coming in, so I'm going to go ahead and sign off. Like I said, the next workshop will be on September the 16th. We'll send out a recording of this presentation tomorrow. Thank everybody for coming. If you have questions in between workshops, by all means, hit this help button, and that will send us an email, and we get back to most of those pretty quick. And yeah, we sort of, much like in these workshops, we sort of, take all comers. We can't provide individualized investment advice, but we're happy to answer, whatever sort of questions we can. Okay, so if you want to improve your portfolio score, generally what you would need to do is move dollars into stocks that have a higher score. Right, so if your average score is a 75 and you want to move that higher, you need to have more dollars invested in stocks that have a score that's higher than 75. It's really as simple as that, right? Like that's kind of how averages work. Is you just if you want to move that score up, move those dollars up. But really, I'm not sure. I'm not sure that chasing an overall score is necessarily the way to go. I think most people, the overall score is a good starting point in terms of gauging the health of their portfolio, the health of an individual stock. But sort of as I said earlier about fundamental versus technical analysis and time frames, I think what you may want to do is figure out what your time horizon is and focus more on the scores that relate to that time horizon, right? So the fundamental and the valuation will be for longer term investors, and the sentiment is at our absolute shortest score, and the other technical things are all a little bit shorter. And so if your time is more than 1 year, you're probably going to want to look more at things like the fundamental score, the valuation score, and the maybe the long-term technical score. Those are probably more important to you than the overall score. Like I said, the overall score is a high-level view that'll give you a good idea, sort of, what's going on from a high level. But in terms of like what your specific goals are, you need to drill into what a score that is more relevant to those goals. All right. I hope this was educational for some people. I always enjoy doing this. I hope other people get a lot out of it as well. But yeah, I'm going to go ahead and sign off here. Thank you all for coming. Thanks for subscribing to Investors Observer, and we will talk to you in 3 weeks, if not before.